Welcome back, guys. Today we're going to do another three stock analysis. We're going to be checking out TJX companies. We're going to be taking a look at GENK, which is like it's a restaurant brand that does Korean food. And then we're also going to be looking at Wingstop, one of the most overpriced companies in the entire market. So that one should be interesting as well. But yeah, over the past 5 years, Wingstop has gone insane. We're going to start with TJX in today's video. So here we go. Over the past 5 years, they're up 107%. Definitely outpaced the S&P 500. Very strong performance from TJX. They basically sell home goods like furniture and stuff, and then I guess some clothing and such. Yeah, they operate stores. Their market cap is 120 billion, so very large company. Price to earnings ratio of 26, so kind of steep. Hopefully they have some growth. Coming down here a little bit, we've got a quick look at their growth and their margins. So they went from 41 billion to 54 billion, which is like a 25% increase in their revenue over the past 5 years, and their net margin has stayed fairly consistent around 7 or 8%. And yeah, so 25% revenue growth, but their share price is up 107%. So definitely some multiple expansion there. Seems like it might be overpriced at this moment just based on that. Looking at the statements here, a closer look, yeah, you can see it's very consistent growth, about 7% or 8% every single year, which is really, really amazing to see. Probably has to do with a well-run company, good management, and very consistent margins. Whatever they're doing, it's working. So we'd probably expect that moving forward. For their balance sheet, they have a decent balance sheet, only 7.58 billion in debt, so not too bad there. Cash flow. What are they doing with their cash flow? Well, they buy back lots of stock and then they pay some dividends. It's like whatever they have in free cash flow, they buy back stock and pay dividends. They actually, well, they must have had a lot of cash on their balance sheet in 2021 because they paid off debt, they bought back stock, and they paid dividend with only 2 billion in free cash flow. But yeah, they basically pay out whatever they can to shareholders, so that's good. Looking at their return on invested capital is really high. Wow, that's nice, 25%. Their gross margin is around 30%, and the net margin is pretty consistently at 7 or 8%. So all good things there. Taking a look at what the analysts are thinking. The analysts are thinking they're going to do $4 a share, going up to 4.55, and they're going to have a 3% increase this year in their revenue. They'll probably be able to beat that, I think. And then into 2026, I guess, 6% increase. Let's check the stats, check the short percentage. Short percentage at 1%, that's very low. That's a green flag. Let's look at the model I have. Now I put the estimates here. Buybacks of 2 billion at that 7.5 billion, discount rate of 10% because I want a 10% return on all of my stocks, and an exit multiple of 20. They're currently trading at 26. Definitely think that they probably should get a little bit lower, especially if their growth slows, which maybe it won't. If it won't, if it continues to grow like it has, then you could probably push this exit multiple up a little higher. But I have them growing at 7%. And with their earnings growing at 7%, the fair share price is $87 a share. And with the revenue margins model, I have their profit margin at 8%. That's slightly higher than what they've done in the past. I think they'll be able to hit that. And their revenue growth at 7%, I think that's completely fair for this business. They come out to a fair share price of 85. I'd say if you bought them today, you'd probably be expecting like maybe like a 6 or 7% return, so not terrible. Probably better than bonds, and definitely possible that you could push this exit multiple to 25 instead. And if you push it to 25, then you could probably expect a 9% return. So definitely not a bad company. I do think it's a bit pricey right now, so I would personally wait for it to drop a bit. And it's also in the furniture and apparel market, so if we have any downturn in the economy, this company is probably going to get hit pretty hard. And yeah, that's what I think about TJX. Let me know what you guys think in the comments about TJX. We're going to move on to GENK now. Okay, now let's take a look at GENK. I got everything ready for it, so here we go. Over the past 5 years, basically, well, they IPO'd just a year ago, so this is actually a very relatively new company, and they're down 40% since they IPO'd. Not great performance. Normally, I'd stay away from IPOs for about a year, so maybe now is a good time to take a look at it. Now, the market cap is 350 million, so very small company. Definitely has room to grow, and it's in that restaurant industry. So if this becomes a popular restaurant, it could expand all over the place, relatively quickly, kind of like a Chipotle. Um, don't expect it to be like a Chipotle. Chipotle is a one in a million. So there's a lot of restaurant brands that pop up like this, and a lot of them fail. So we really have to dig into the numbers to see what they're doing. Their price to earnings ratio right now is 45. That's very high, but it's mostly because they had bad margins last quarter or last year. But I think 2022 was the best representation of their margins, and their margins are about 6%. Looking at their financials here, they've been growing by 16% and then 10%. And on a quarterly basis, it's about 10%. Last quarter, it was 15. I would expect about 10 to 12% moving forward. Definitely possible that growth is higher or lower. It's very hard to predict the future on these types of stocks. And yeah, the reason why I think 6% is the best one to pick is in 2022. Well, basically their gross profit's pretty consistent in each of these years, but in 2022 they didn't really have much affecting them in terms of like other expenses, and so that's why I think that the best representation is 10 million in profit, for 160 million in revenue. Going to their balance sheet it's okay. It's not great. They've got net debt of 118 million, so like it's not too bad. Looking at the cash flow, yeah, they don't really have money to give out to shareholders yet. They're still trying to grow, so uh, tough to say what they're going to do with the cash flow in the future, but they're not doing much with it now. For their stats, return on invested capital is quite low. Gross margin is pretty low. Yeah, their margins are not great, so that's what makes it tough about the restaurant business. Let's look at the analysis. So they don't really have any earnings right now, so we're not going to use the earnings in our model. We're going to be using revenue and margins. And they do expect revenue to grow by 12.5% and then 18% into 2025. So that's pretty good growth estimates there. Yeah, pretty crazy growth estimates, I think. Looking at the stats, their short percentage is 3%, so it's not horrible. It's not quite 5%, so that's kind of a green flag. I mean, especially with being such a small company and with them being down 40% in a year. I think 3% is not terrible. Looking at the model, I put the revenue estimate here. I put their net debt there, and the exit multiple 25. That's probably, well, if they can sustain their growth numbers, then 25 is okay, I think. I have their growth at 10% every single year. Now, like I said, it's really hard to predict where their growth is going to be. It could be higher, it could be lower. It depends if people like that Korean restaurant in the United States, because that's where it's based. And their profit margin at 6%, I think, yeah, 2022 was the best representation of their margins. So a profit margin of 6%, I think, is going to be pretty consistent. And I think that's what they're going to be able to do. Maybe over time, they're going to be able to expand that margin a little bit. But yeah, I think 6% is a good starting point. And with this, their fair share price comes out to about where they're trading at right now. But after their debts, then you could say that their fair share price drops to like 9, and that would give you a 10% return moving forward. Yeah, this is a highly risky stock. I would not put too much money into it. It's like it could take off. You could make a lot of money on it, but at the same time, this company could do nothing for years and years and years. So yeah, I don't think I would open a position into it, but yeah, it might be something if you really like Korean food and you think that Korean food's going to take off in the United States, then this could be the stock for you. Anyway, let me know what you guys think about this GENK, and let's move on to the next one, which is probably the most overpriced stock in the market, Wingstop. Okay, now for Wingstop. Wingstop has had crazy performance over the past 5 years, up 340%. You can see how volatile it is. It was at 172. It dropped all the way down to $73 a share, and now it's risen right back up to $370 a share. Not quite sure what happened. Their fundamentals have been pretty much consistent. I'm not quite sure why it dropped so much here. I'm not quite sure why it rose up so much like this, but let's take a look. Their market cap is 11 billion, so pretty large in terms of market cap. Their price to earnings ratio is 134, which is insanely high. Insanely high. Their margins too are pretty good, 15%. And their revenue is 460 million last year, and their market cap is 11 billion. So their price to sales is like 22. Very, very extremely high actually, for especially just for like a restaurant company. Financials. Their revenue growth has been very stellar. Even last year, it was 30%, and first quarter they've got a good first quarter, 34%. So yeah, they've got strong growth, and they're projecting strong growth into the future. The problem is their valuation is crazy, and it's hard to predict the future. So their growth could easily slow. Their balance sheet, they have a negative book value, so their balance sheet's not good. They have a lot of debt, 560 million. I mean, they're going to grow into this, and they'll probably be able to pay it off. So it's not that big of a deal. Usually I don't put too much stock into balance sheets, except for I do add them to my models, so they do get accounted for. In terms of cash flow, the cash flow, it looks like they actually bought back a lot of stock in Q3 of 2023, which is kind of crazy at the price that they probably bought it at. But now they're actually issuing some stock, so that's probably smart. But they're not really issuing very much, so it's not really that big of a deal. And then they pay a small dividend, it looks like. Yeah, otherwise they're probably just putting the rest on their balance sheet. In terms of stats, their return on invested capital is very good, 20%. That's very nice. Gross margin is very high. Wow, crazy gross margin at 80%. And their net margin is about 15%, and pretty consistent too. Looks like 10 to 15%. They might be able to expand it up to like 18. Looks like they did 1 year, and last quarter they were at like 20. So they might be able to expand margins a little bit. I found this slide. They have 1,500 restaurants already, and they think they can expand to 4,000. So it's basically like 2.5 times. And then international markets, they think that there's some space there. Now, they might possibly be able to get to this. They might not. I just know that the wing industry is very competitive. There's a lot of different wing companies out there. You can literally get wings from any restaurant. Not quite sure what makes Wingstop different from the other companies out there. Let's take a look what the analysts think here. The analysts are thinking 3.42 going up to 4.15 in earnings, and their revenue is going to be like a 27% growth this year, and it's going to slow down to about 17% into 2025, which makes sense because the larger you are, it makes it harder to grow because you have to expand by exponentially more locations. In terms of stats, they have a 5% short percentage, so that's kind of a red flag, but it's actually not as high as you would think. Well, I don't know. I think 5% is fair for this company because like even though they're super overpriced, they are in a crazy uptrend. So people going short this company could possibly get destroyed if this company just decides, nope, we're going to push the share price higher. But yeah, I don't blame people for shorting it either because it's way overpriced and the price should come down. But let's look at the model I have. I put the estimates here. Net debt of 560 million. I have the exit multiple quite high at 30. That just because if they are able to achieve these numbers and they're able to grow like they have been, and they can do that sustained for however long, I don't see why they couldn't command an exit multiple of 30. It might be kind of high, but I think that's okay. And for growth, I have them growing at like 15%. And even with that strong growth, their fair share price is far below what they're trading at now. And with the revenue margins model, I have their growth at 17%. That's kind of what the analysts are projecting. And the profit margin at 15%. It's possible that they are able to expand these profit margins, maybe up to 20% by 2023 or by 2031. Even with that, which I think that this is quite optimistic for this company. Like, even though they've had great growth in the past, I mean, how much more can they grow? They're already at 1,500 locations, and they think they can expand to like 4,000 in the US. And over the course of these 7 years, it looks like their revenue is tripling. So will they even be able to triple their revenue if they already have 1,500 locations? That's where I don't know. Yeah, in 2020 or 2031, yeah, that's a triple in their revenue. And they don't even have that much space for the locations in the US. So that would have to come from international growth. And yeah, it's going to be very difficult to sustain these growth rates. And by the time 2031 rolls around, they'll probably be a mature company, in which case their growth is going to be slowing down. Their exit multiple is going to have to be lower. And so the fair share price is going to be even lower than this. So I think that this is quite optimistic. And yeah, they're still overpriced. So please don't buy this company. I think it would be a very, very big mistake. Moving forward, yeah, not even 4% returns. You're probably looking at like 2% returns moving forward. Yeah, not even. Just stay away from this company. It's way overpriced. Even though it had very strong performance in the past, it's most likely not going to continue into the future. So that's what I think about Wingstop. Let me know what you guys think about Wingstop. Also, let me know what you think about the 3 stocks that we did in this video. You guys can also try out this model for yourself. Just check the link in the description. You can try it for free. And yeah, make sure to hit that like button. I'll see you in the next one.